Okay, hello everybody, and welcome to Investing with IBD, sponsored by Fidelity. I'm Alyssa Cora, multimedia content editor at IBD, and joining me today is my co-host Justin Nielsen, IBD Market Research Director. And our special guest today is Bill Studebaker. He's President and Chief Investment Officer at Robo Global. On today's show, we're going to take a quick look at the current market action. Then we're going to do a deep dive into the exciting trends in the robotics and artificial intelligence space, and take a look at a couple of stocks and ETFs. But first, Justin, break down the market action for us, because today there was a pretty significant development, I think.
Yeah, now I'm going to keep this quick because I really want to hear so much from Bill Studebaker. But yes, what we were seeing earlier this week was we had a little pullback in the indexes. S&P 500, look, it was being held, to its 10-day moving average line. So you look at the index, not much to see there. The NASDAQ composite, that found support at its 21-day moving average line today. So again, the index doesn't show that much weakness. What was happening underneath the surface, though, a lot of growth names were getting hit, and that was making it very challenging. If you didn't have a lot of profits in your stocks, you were probably getting some sell signals on your stocks and maybe having to unwind some of those positions. But if you had some bigger profits, it was a little bit easier to hold. Now that we've got this bounce back, the one issue that we've been seeing is on the good side, this didn't really happen in very heavy volume. We don't have much distribution days hitting either the S&P 500 or the NASDAQ. Now that the NASDAQ is back near new highs, the S&P 500 has been right there at the new high level. Russell 2000, that's been kind of just darting around its 50-day moving average line for a while, a little bit weaker there. But today it was showing a lot of strength and getting back to that level. So a nice reversal that we saw today. Now the question is, will it hold? Will this rotation continue? And where do we go from here? But right now we're still in that confirmed uptrend and looking for stocks and again diversifying quite a bit, because we're seeing a lot of strength in a lot of different areas. It's not just tech in this case. We've got the reopening plays, we've got some of the cyclicals, and today we certainly saw a lot of strength in chips, and we'll get more into that with Bill Studebaker, our guest.
Yes. So, Bill, let's bring you in here. When you take a look at the performance for the Robo Global Fund family of ETFs, huge gains in 2020, a little bit of a break right now, consolidating those gains, but a huge move in 2020. And it sounds like there's a lot of room left when it comes to the growth of these trends playing out.
Oh, well, exactly right, Alyssa. When we launched Robo 8 years ago, we had high conviction and belief that we were on the cusp of ubiquitous automation. But fast forward 8 years later, and we couldn't be more convicted. I mean, there is an undeniable inflection point going on because of performance capabilities of computing and the cost curve that's bringing to the forefront an array of use cases that is pretty inspiring. And so as we look around, there is growth coming, everywhere. I mean, look at the wealth creation that's happened in the last, 18 months. It's pretty astounding, particularly as it's coming out of technology. And when you look at robotics and AI, what's exciting about these technologies is that they're not niche technologies, rather they're foundational technologies that are being applied to all industries and all markets. And if you look at the penetration rates across virtually every subsector of the economy, we're at low single-digit penetration rates. So this is going to go on for years, if not decades.
So then talk to us a little bit more specifically about Robo Global and what you guys are doing with the ETFs. You have a couple of different ones looking at different areas within this space.
So we have three different indices that I'd love to talk to you about. Our first kind of our legacy product is Robo, which is our robotics and automation index that we launched 8 years ago. And that seeks to play across the value chain of not just the technologies, but the applications. So for technologies is what makes an autonomous system work. It's the computing, the AI, the processing, sensing, and the actuation, and the integration. And the use cases of where is robotics being deployed? It's being deployed into healthcare, into ag, into food, security and surveillance, warehouse automation, just to name a few. We then, during our research of getting pretty inspired by how this was playing out, we then, kind of were looking around what sectors is really going to take off, and that brought us to healthcare. And with H-Tech, H-Tech is sort of a play on the future of healthcare. A lot of people, when they invest in healthcare, they tend to invest kind of through the rearview mirror into the therapies and into some of the services and so forth. And the pharma companies love that we all can, contract or have a chronic illness, so they'll come out and try to give some remedy that may, possibly delay that. But not necessarily prevent it. Okay, as we looked at healthcare, we got really interested because the future of healthcare has to change. We live in a world that's actually sick care. We wanted to look at a world of prediction, prevention, individualizing medicine, which is the foundation and around what healthcare or H-Tech is built on. So we had to go out similar to Robo and create our own proprietary classification system to identify the future of healthcare, which is genomics, which is lab process automation, which is prediction, preventive medicine, regenerative medicine, genomics, medical instruments, to name a few. So that covers that sort of ecosystem. And then finally, we looked at our next sort of challenge was into understanding AI. And so we launched an index with the ETF ticker Think THNQ that captures the technologies and infrastructure providers around there. So again, we sort of look at the technologies and the applications of where is AI being applied, and it's a pure play on AI. And importantly, when we go into putting the companies that go into the index, there is a tremendous amount of research that goes into this. The way we essentially capture the companies is that we screen for companies that have high revenue purity. That's really important to us. It's about 50% of our factor weighting or attribution for selecting a company. We have a proprietary ranking system that ranks the companies quarterly. So we're looking at revenue purity as being 50% of the mix, and the other 50% is trying to evaluate the companies on the basis of their market share leadership, their technology leadership, and where they're investing, because presumably the investing piece is very important and hard to always, kind of figure out. But the important thing here is those are companies that are likely to improve margins because they're focusing on those activities. And importantly as well, they're likely to drive a higher revenue mix as that part of the business accelerates. So we have a pretty high touch process that goes, into selecting the companies.
Okay, so first of all, with your H-Tech, I want to make sure that people realize that Arusha did a pretty deep dive with your colleague Nina on a November 12th, 2020 episode of the podcast Investing with IBD. So we're not going to necessarily touch on a lot of those things because it's already been covered. So we can consider this kind of segment 2, but I highly recommend people check that out. On
investors.com/podcast.
Absolutely. And November 12th, 2020 was the episode. Now, you've got 3 different things, but you're talking about the use of artificial intelligence in the healthcare industry, robotics and automation. I mean, we had ISRG have, just blowout earnings and a huge move today in robotics, but that's also in healthcare. How much overlap do you have between all 3 of these indexes? And how do you decide, okay, this one goes here and not here?
Well, there's actually very low overlap. Importantly, we have to fit into the index, or any of our indices that have to fit within one of our subcategories in terms of the sectors. So it has to fit there. Again, has to have high revenue purity, and then we're looking for companies that are established in terms of having market share leadership and technology leadership. So we're not really throwing paint against the wall here. There's a lot of active research that goes into selecting those companies. So then we pass it on to our calculation agent that looks at more passive filters for including that into the index. So that's essentially how we do it. But the overlap between all the companies is pretty low. When you look at healthcare, obviously that's a pure play only on healthcare. So the crossover with Robo is only about 12%, and with our Think Index, Robo to our Think Index is about 15%. So the overlap is rather low. And importantly, the overlap with traditional indices is exceptionally low. If you were to take Robo, for example, and compare it to most traditional indices, you would see that the overlap is in the low single-digit percentages, and depends on the index you're looking at. For Think, it's a little bit higher because it's a little bit larger cap names, but generally speaking, if you were to compare that to a lot of traditional technology indices, it would be in the low teens.
Mm-hmm. Yeah, I think that aspect of revenue purity is really important because I think that's the challenge with a number of thematic ETFs that are on the cutting edge of new trends. So do you think that that's what makes RoboGlobal stand out in the marketplace?
Well, I think the revenue purity is definitely important, but it's also important to capture the companies whose business may be undervalued or underappreciated, where that mix of the business may not be as big now, but it's growing exceptionally fast. And we have a lot of examples of companies where the revenue purity at the time might have been a little on the lower side, but the growth was pretty sensational, and you've seen that show up in terms of the performance of the companies, because what's often happens then is you get multiple expansion on top of significantly higher earnings and revenue growth. So those typically make big companies. Well, if we were to study the attribution of our performance, looking back historically, and this is just for Robo, I don't have the data for the other two yet, but if you were to look at what might be more pure play companies versus non-pure play, I think we have a modestly higher skew on performance attribution from the non-pure plays. Again, for that reason, where they were sort of underappreciated, valued by Wall Street. And importantly here, Alyssa, is a lot of these companies are very underfollowed by Wall Street. I don't have a hard-coded number to give you, but I would say 30-40% of the companies, would not be followed by, or only 30 or 40% would be followed by a lot of the big wirehouse companies. And because a lot of these companies are based, globally, there is a very inefficient coverage, and that serves, us well.
So we need to take a break right now, but when we come back, we're going to be talking with Bill about some of these emerging trends that are happening in artificial intelligence and robotics, and kind of get into some of these different sectors that you're seeing the strength in and where this could go in the future. So that's coming up right after this break.
Fidelity Investments is hiring now. If you have a Series 7 financial license, you'll find opportunities for both remote roles and regional center careers across the country. At Fidelity, we provide opportunities to help you change lives every day while making sure you have benefits that make an impact in your own life. Flexible work environments, training, and resources to help you grow, all adapting with you throughout your career, because your workplace should work for you too. Visit FidelityCareers.com to explore jobs today. Fidelity is an equal opportunity employer.
Welcome back to Investing with IBD, sponsored by Fidelity. I'm Justin Nielsen, along with my co-host, Ali Quorum, and our special guest, Bill Studebaker from RoboGlobal. Now, let's go ahead and get into a deeper dive here into the robotics trends. And, one of the big things that you were mentioning is that, people really have to kind of get their minds wrapped around a very different way of thinking, from linear to exponential. Can you talk a little bit about why that is?
Well, it's a pretty profound shift that we're seeing, and to be successful, I think you have to change your mindset. I mean, we as human beings, as investors or as consumers and business managers, understand linear thinking. So if I take 10 linear steps, where am I going to be? I mean, take 10 steps 3 feet apart, I'm basically 30 feet away. We can understand that. But if I'm going to take 10 exponential steps, that's less intuitive and more difficult, right? 1, 2, 4, 8, 16, 32, 64, 120, 256. That's exactly what's happening right now. And so the companies that are successful now are being able to understand this and manage their business in a way that's much more profound than it ever has, because there's a mindset now towards looking for larger variances when they're looking at their planning and investing and things like that. And companies aren't just trying to hit the base hit, they're really looking for grand slams. And companies like Bezos have done this, no one's done it better than Bezos. I mean, Bezos is probably architect the best venture capital fund in the history of humanity, with his ability to make the kinds of bets that he does. He looks at things outside the box, and I think we as human beings and as investors and managers, et cetera, need to embrace that way of thinking.
So for those who are a little bit more new when it comes to all of these themes in robotics and artificial intelligence, can you lay out what's out there, because I think there really is a lot, in segment one, we only scratched the surface, but there's a lot going on.
Well, there's the trends are everywhere, and all three of our strategies, Robo, H-Tech, and Think, capture the benefits of what's coming. I mean, we've got factory automation that's booming. We've got China is remaining the world's top automation, story. We've got logistics to warehouses. The growth is going to continue to soar. Less than 5% of automation, or I'm sorry, factories or warehouses in North America we would consider highly automated. So the runway is big. You've got big data and AI that's everywhere. It's enabling digital transformation. You've got e-commerce and the immersive experience that it's going to begin. I mean, as consumers, it's a lot easier to go into a store and try on a pair of pants, and how they fit and how they feel. And you may be more reluctant to do that or to buy something online unless you have an immersive experience. And, that's coming. You've got early detection in healthcare that's emerging. You've got, prediction and prevention, in healthcare everywhere. And that's going to drive tremendous, innovation. So, there's almost too much to talk about, but happy to dig into anything that you wish to talk about.
Well, which one do you think is seeing the most meaningful rollout here today? What's the closest to really being a widespread trend? You said factories only 5% in North America, highly automated. Is that an area that you're seeing a really companies being swift to act to get more automation there, or what's that's kind of the near-term focus?
Factory automation is going to continue to boom. I mean, you get the brutal combination of the downturn in capital spending in 2019, followed by the shock waves of the pandemic, hit automotive and electronics. That was the two biggest sort of industries that rely on robotics and on automation. But demand has bottomed in China, and it's clearly stabilized in the US and Europe. And we expect to see the installed base of robots exceed 3.2 million by the end of this year. Now, that may not sound like a lot, because it's not a lot. That's a tiny fraction in the world manufacturing employment base, which is 360 million. So this is going to continue to go on for years, if not decades. If you look at that, places in China right now has roughly 1.9 robots per 100 people. So that's roughly half the density that is in places like Japan, or even less than in Korea and Singapore. So there's a big outlook there. We touched a little bit on logistics and warehouse automation. The pandemic transformed the supply chain, as well as the expectation and demand of buyers of logistics services. So the disruption of the consumer supply chains is driving change, and we expect to see a new surge in warehousing demand, especially for things like temperature control. It's going to begin to take off, and again, less than 5% of all warehouses are considered heavily automated. So this is going to go on for years, if not decades. So we feel pretty optimistic about those two trends.
Well, and I guess that's another point here to your exponential thinking. One of the hard parts that people have wrapping their heads around, compounding, is how different that curve looks at the end, a few years out, as opposed to at the beginning. And so with a lot of these, you're talking about years out for this. So what is your timeline as you're looking at these companies to put into your index? How far out are you looking for some of these to really produce for you and maybe become fruitful?
Well, I mean, realistically, we're looking for them to be producing companies the second we put them in. I mean, we're not speculating on technologies. For example, maybe we're evaluating a surgical robotic company that hasn't even passed FDA level 2 or 3 certification, right? So we're not going to put a company in our index until they have a certification, or until they have a proven commercializable product. And even so, we may even wait a little bit to find out that there's some commercialization going out with the company. And there's a lot of great companies that may have a great technology, but they don't have a very good management team or any
Right.
proven market experience. So we may, hesitate to pay some attention to that, right away. But again, I think it's important to look out, years ahead. And you look at, you brought up the case of Intuitive Surgical put up phenomenal numbers, today, and they only have 6,000, roughly speaking, robotic installations out there globally.
Mhm.
That's now a $100 billion market cap. This company was started back in the late 90s, called 1998. And I remember reading research reports, months back that were in the early 2000s, and people were concerned about the technology, didn't know if it could scale. They didn't know about the consumables, how that would play out. They didn't know about doctor, acceptance rates and what the penetration rates are. Well, fast forward $98 billion later, and that's the answer. And you did have to be a little patient. I guess you had to wait 15, 20 years to put up that kind of exponential return, but you did. And there's a lot of great companies, out there that, are playing in robotics and AI.
Well, and to be clear, you really didn't have to wait for ISRG, the stock, to necessarily give you that performance. I mean, that was a strong performer a decade ago. So
Sure.
A lot of these, there is that forward looking of what potential there is. And, I guess that's what you're trying to capture in your index. Exactly.
So I think it's important when you look at this trend that this is not a play this for the quarter or the year. This should be viewed as a solid 3 to 5 year, sort of return, outlook. We have some people that tend to look at how they manage money. They'll look at a liquidity bucket, a legacy bucket, and a longevity. And typically people that, care about liquidity have a different sort of risk managed view. Conversely, people that are in sort of managing money for a legacy experience and longevity will tend to consider looking at thematic strategies. And I think those complement those portfolios well because you have the time horizon. And I think if you're looking out, 3, 5, 10 years and looking back at robotics and AI, it's going to feel a lot, in my judgment, a lot like the internet does. I mean, everyone now recognize what the internet does. I mean, the internet changed how we socialize, how we consume media, brought about search, e-commerce. Great, amazing. Okay, that's it. Robotics and AI are about to change, all industries and all markets. It was interesting, a couple of years back, Bill Gates had talked about robotics being more ubiquitous than computers and more transforming the internet. Roughly, 6 months ago, you had Sundar Pichai coming on saying that AI is the most important technology of our lifetime. And so, these are technologies that are not in everyone's portfolio, but looking out and then looking back, I think people are going to wish they had the exposure there.
And on that point, I mean, you mentioned Jeff Bezos being one of those exponential thinkers, the likes of Amazon, Microsoft, these big tech companies. What do you think investors can really take from what they are doing in this space in terms of acquisition and activity and those sorts of developments?
Well, I think that what they're taking away is that there is, unlimited growth potential out there. I mean, thinking back, 18, 24 months ago, we were talking about no growth, low growth, forever. The pandemic came, sort of changed the short-term dynamic. But the only way for us to get out of this pandemic and to sort out our $20+ trillion debt situation is through growth. And robotics and AI, I think, are the tools that we need to help do that, and to help reboot, productivity and growth, the likes of which very few people can want to think about. And I think the big successful CEOs understand the importance of where we're going and the outlook, and the change that we're going to see in the next 10 years is going to outpace anything and everything we've seen up to this point. So, from an investor standpoint, I think you need to stay here. You need to be invested and watch how this plays out.
So we kind of teased this at the beginning, a little bit about this chip shortage, and chips are so important for so many elements here. How is this chip shortage that we're seeing in everything from automotive to I mean, just so many things? How is that affecting a slowdown in robotics or AI, or is it really not affecting things? What are you seeing there?
Yeah, I would say broadly speaking, the semi shortages are going to continue through this year and early next year. Lead times in some areas are as long as 52 weeks. But unlike other semi cycles, this is less cyclical and less seasonal and much, much, much more secular driven. We've got mega trends that are happening all at once. You've got the massive cloud deployment. You got the building of the AI systems. You got the 5G upgrade cycle. You got autos going through electrification and industrial machinery going through the next generation cycle. So I think this is all coming at once, and you need to be exposed here. And the semi ETF index is, I think, up 15 or 18% year to date, kind of reflecting this. And you need to be exposed to that. We own, a lot of the leaders in, AI and data centers, like NVIDIA, AMD, and ASML, but also lesser known companies that are going to benefit, like MediaTek and Global Unichip and Brooks Automation and Teradyne and Ambarella. We can talk about, maybe a couple of those names at a later point. But I think this is an important point. Think has about 14% exposure in semis, and for Robo, it's about 10%. So you're getting this exposure without having to own the individual company and having potentially any sort of idiosyncratic risk.
Well, Bill, I think that's the perfect segue to our final segment. We're going to start digging into some of these individual companies and take a closer look. That's right after the break.
Fidelity Investments is hiring licensed financial professionals now. Reach your career goals with the support of a financial lender impacting customers and employees' lives for over 70 years. We're hiring now with remote roles nationally. So if you thrive on helping others, if you're self-motivated, find career growth at Fidelity. Find stability you can count on. Find the flexibility you want and the opportunities you need. Find your Fidelity. Visit series7.fidelitycareers.com. Fidelity is an equal opportunity employer.
Welcome back to Investing with the IBD, sponsored by Fidelity, and with Justin Nielsen and Bill Studebaker. So where we left off, we were talking about the chip shortages and how that plays into the AI and robotics themes. You mentioned Ambarella as an interesting name to maybe take a little bit of a closer look at. So can you talk to us about what they're doing and why that stands out to you right now?
Yeah, Ambarella definitely should be on your radar as a kind of autonomous vehicle play and as a go-to AI stock. They recently posted, or last quarter, a beat and raise, reflecting a kind of a continued growth of computer vision and strength in consumer platforms, which include consumer surveillance and a rebound in automotive production. And we see Ambarella emerging as a growth stock in the market that's been paying a premium for semiconductor growth, especially around new categories that include AI computer vision. And the company is migrating from being historically a video processing based solution to an AI computer vision chip. And the transition has been building on for a couple of years. So the company's revenues that come from computer vision surpassed 10% for the first time. And as we talked about earlier, I mean, that's kind of what gets people focus, is when one part of their business begins to accelerate. This is exactly what's happening when it comes to computer vision. And the company is now quantified the automotive funnel of cumulative revenue now is in excess of $600 million by 2026. So that implies a 200% growth in autos with potential upside to those numbers. So as this continues to happen, I would imagine that Ambarella is going to be in a lot of people's M&A pipeline. Similar to how Mobileye was bought by Intel, I think that this is very likely a emerging M&A candidate as we go forward.
Well, and that's something that you were kind of talking about at the outset, that there is in this space a lot of that M&A activity. And what's so interesting about Ambarella is, as you said, there's this whole transition. And whenever we've seen companies in the past make these transitions to something potentially more profitable, in this case, from your video to now it's computer vision, I mean, that's pretty interesting. And what is it about Ambarella that I guess is enabled them to make that transition? Or are there other I guess names in this space that are kind of, again, making these transitions from something that maybe not AI or robotics oriented to something that is definitely in that space?
Well, speaking of Ambarella, they made this transition a few years ago. They used to be heavily tethered towards the GoPro, with upwards
Right.
30% of revenue,
Mm-hmm.
Came from GoPro unit levels came off considerably. That had a big impact on Ambarella stock, which went from a high of 130 back down to somewhere in the $30, $40 area. And now it's probably up at around $120. But that had a big impact. And very quietly, about 3 years ago, they bought an autonomous driving technology based in Italy for roughly around $40 million. And this was before GM bought Cruise for $800 million, or right before. And obviously we know the valuation of Cruise is somewhere in the 12 to $15 billion level. So when we look at Ambarella, this is a company that's been around for a few years, and the transitions, I think Wall Street loves to see when the green lights go on right away. But it does take time to develop a chip in their case, begin to test it, and to be able to get the tier one auto suppliers to commercialize with it. And so we're beginning to see that now. They've again have $600 million in automotive business wins. This did not happen overnight. It's taken the better part of a couple of years. And that speaks to another acquisition that just happened in our index. FLIR was bought by Teledyne in the beginning of the year. And what's interesting about that is FLIR has been around for, I believe, 42 years, okay? And Teledyne just bought them. Teledyne provides instrument, digital imaging, and engineered systems mostly for aero and defense, while FLIR develops thermal imaging, measurement and diagnostic systems. And put the two together, and this is going to become a sensing powerhouse business. And the question is, so why didn't Teledyne buy it earlier? I'm not exactly sure. The stock was cheaper before, but certainly putting the two together, they've got a unique ability to supply autonomous unmanned systems, and they serve different markets globally and both land and sea. So this is kind of a marriage made in heaven, as is the other acquisition that you and many of your viewers are familiar with, where Microsoft just acquired Nuance. And Nuance is actually in all three of our innovation indices due to their leadership in intelligent systems powered by AI, and such as speech acquisition and natural language processing. And they've been around, believe it or not, for probably 25 or 30 years. The company has been at the forefront of driving digital innovation with AI technologies. They've got 2,300 patents, and Nuance is the undisputed leader in healthcare AI. So this was a great opportunity for Microsoft to come in and accelerate their push into what they see as a $3 trillion healthcare opportunity. So the acquisitions are everywhere. Since we launched Robo 8 years ago, roughly a third of our index has been acquired or attempted to be acquired. Last year in Robo, we had, I believe, 7 acquisitions. In our H-Tech and our Think indices, we both had, I think H-Tech had 5 and Think had a few less, maybe 3 or maybe 5, I forgot offhand. But M&A is all over the place in our indices.
Well, and Nuance was had quite a number of acquisitions that it was doing before it got acquired itself. I mean, there were all these little companies it was gobbling up over the last decade, at least. And again, it's turned into a powerhouse because of a lot of that technology. So is it a lot of times more profitable for these bigger companies to just get that innovation from someone else rather than develop it in-house?
Well, I think that's exactly what you're saying, but I think the companies, the bigger companies, hesitate to jump in until the mix is big enough that they can move the needle for them. I mean, this was the second biggest acquisition that Microsoft has ever done. Their last acquisition that was that big was obviously LinkedIn. But I think that this is going to, tip the scales, that people need these technologies to enable their business. And I think companies, recognize that now, and that building and growing is a lot more important than just, paying shareholders dividends and buying back stock. And there's a lot of execution risk that goes into these deals. But in both of these cases, just recently, Teledyne and FLIR was a very easy match to put together, and I think it is with also with Microsoft and Nuance. Microsoft, understands the opportunity in healthcare, and they bought one of the biggest AI powerhouses in healthcare. So again, we think that the race is going to be on for more and more acquisitions.
And at IBD, we love, of course, looking at individual stocks, and we're trying to find the best of the best, looking at really in depth at that technical analysis, and perhaps it is for shorter, holding periods. But with the ETFs, I mean, these indexes that you have, there's a really deep dive and a lot of research that goes into what you guys are doing. So can you talk about being able to capture this theme in the portfolio with that ETF wrapper?
Yeah, it's a good question. I mean, that's what I think helps, separate us, is the team that we have. I mean, not only I think we're fortunate to have identified some of these themes early on, but it was very important to then assemble a team of not just financial but industry experts. We have 7 PhDs in our team that give us an amazing lens to kind of how to think about the technologies and where the growth is happening. I mean, these are individuals that are amazing thought leaders, that are entrepreneurs, that are developers. And so they sit on the front lines of using many of these technologies. Their Rolodexes are obviously sensational, and they give us great insight into the technologies. And we use their input very judiciously, every quarter as we're assessing our index. I mean, we do a ton of research every day, every week, every month, every quarter leading up to our rebalances to try to stay on top of the companies in terms of, again, where the revenue mix is, where their investment leadership is, where their market share leadership, and where they're investing. We do this through a lot of fundamental due diligence of meeting with companies, in presentations, on one-on-ones, in now more and more Zoom meetings. But we have a very active research component with people that are specialized in financial research. So we hope to then obviously put together all of our insights into a tax efficient ETF wrapper that captures the benefits of that for investors in what we believe is a very prudent, risk-adjusted way. And so all 3 of our indices, roughly our top 10 positions are less than 20% of the weighting. And so we rebalance quarterly to smooth out the ride.
Yeah, I was just going to ask, how often do you rebalance, and what kind of turnover rate do you see? So
yeah, the turnover is low on a name basis. It's extremely low. In Robo, as an example, which is our longest legacy product, we've averaged about a name a quarter that we've added. We've had names that we've obviously removed. We've had a lot of acquisition activity. Just because a company goes out doesn't mean we have to put something in. Again, we want to identify the companies that have the highest, revenue purities, and that also, again, have market share and technological leadership to help capture that. I mean, there's a lot of other exposures are out there, and what you typically find are those exposures are very market cap, weighted. Our indices tend to favor a little bit more towards the smaller and mid-size but not super small. Robo, the median market cap is 7 billion. H-Tech is around 12 billion. Think is a little larger because of some of the larger big cap technologies, so it's a little over 20 billion. But again, the active share in these strategies are extremely high for investors to understand. And the last thing I would say that's really important for all of our indices is that ESG is a filter that we use. We spend a lot of time making sure that all of our companies comply with an ESG sort of filtering system that we've imposed, and we have a third party that also helps filter that and for us. And certainly the benefits of ESG investing is undeniable. Those are companies that are typically better run, and they have higher returns on investor capital, and they're better at investing. And so having that framework, I think, is pretty important for us.
And for people not familiar with the term ESG, that's of course environmental, social, and governance, where the look is on on companies that are very aware of those issues and compliant with a lot of those issues that are becoming more and more important to investors. Again, thing that's really fascinating about everything that you've said here is that there's some very disparate companies and all these different industry groups. You mentioned an aerospace defense, computer software, chips. There's just all of these different areas, and they all kind of fit under this umbrella. So where can people find more information on Robo Global and exactly how you kind of go about your process?
Yeah, please, you can review our website. It's roboglobal.com. We have a tremendous amount of content on there every week that we have for investors to enjoy. You can sign up to get our research or newsletter that comes out, once a week. For those that want to get signed up on anything, they can also just go to info@roboglobal.com and send us an email, and we'll be happy to service you any way that we can.
Great. We really appreciate having you on, Bill
Yes.
Studebaker. This is just, again, a fascinating area. As you mentioned, a lot of runway here, and can't wait to see what the future looks like a few years down the road, potentially unrecognizable and unimaginable if things go the way you expect. Next week, we are going to have on a special guest, Kathy Donnelly, co-author of The Life Cycle Trade, longtime CanSlim follower, went to a number of master's programs, now she's become a good friend. So she'll be back on the show to talk about all the latest hot IPOs. So be sure to tune in for that. I'm Justin Nielsen, along with my co-host, Ali Corum, and our special guest, Bill Studebaker. Thanks a lot for joining us, and we'll see you next week. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.